fine folks that trade stocks, Jeremy and Itai and Lauren, everybody, Danielle, shout out. They want to, Hannah, right? So I don't want to leave anybody out. They're like, JC, what is like, what is your like sort of like your steps? Like, what is your method to this whole market thing, right? I've been at it for 20 years. I'm incredibly fortunate to be able to speak to, I mean, seriously, some of the best traders in the world. And it's funny because I had a conversation today with a financial advisor, and he's like, JC, you talk to all these guys, but they don't really pay you that much. It's not that scalable of a business, right? But it's, I'm like, you know what? I do it for free because the information that I'm getting, the ideas that I'm getting, I mean, I don't want to, hopefully they're not watching this, but I shouldn't even be charging them, right? They should be charging me for this. So through all of these conversations, through all of my experiences, I've sort of developed my own strategy. I didn't like reinvent the wheel. 95% of what you see here, I did not invent, right? There's a little JC sprinkle in there, but most of the stuff and the main ideas go back hundreds of years, because markets evolve. We get, decimalization of stocks. There are new markets like Bitcoin and stuff that didn't exist before, obviously. There's ETFs, right? So there's an evolution of the markets, but the common thing, the thing that never changes is you and me. It's investor psychology, right? It's human behavior, fear and greed. We buy when we should be selling. We think like we're the greatest ever when we should really be selling, right? And we think like the world is ending and we're the worst traders ever, and that's the time to be buying, right? Like because we're not built psychologically to be good investors. So because of that, there's a huge arbitrage there, and there's a huge advantage to those of us that are aware that we have those human flaws so that we can extrapolate profits from markets from participants who are unaware of those things. So what do we do about this awareness, right? We're going to talk about 3 steps that I think, I don't care who you are, you could be the best trader on planet Earth. These 3 steps will help you. You could be a brand new trader, just opened up your first Robinhood account. These 3 steps will help you, right? So anybody, any time horizon, you could be a day trader, swing trader, global, macro, long-term investor, whatever it is, these tools can help you, right? What do you think about, how's that for an intro, Jeremy? How did I do there?
I think that was perfect, JC. And again, just welcome everybody to the charting room. This is JC Press. I'm Jeremy Blossom. And just as JC stated there, this is going to be the 3-step system for identifying breakouts stocks. And that's where we make our money when stocks move. We don't make any money when the stocks don't move, or if the stock moves and we're in the wrong, side of the trade. So what he's going to be going over tonight is things like he just mentioned. He's standing on some giant shoulders, people that have been doing this for hundreds of years, and he is perfecting it. But JC is probably the foremost voice in all things technical analysis. He is a chartered market technician. There are less than 2,500 in the world. He's also a sommelier, and I'm lucky enough to call him a dear friend. And so tonight, JC is going to be showing us his 3-step proven system for identifying breakouts so that you can be on the right side of a trade. So if that's what you came here tonight to learn, that's exactly what we're going to show you. So JC, without any further ado, my friend, let's get started.
Yeah, and I just want to reiterate one more time, and thank you for that, Jeremy, but I want to reiterate one more time that this is literally for anyone. I'm telling you, I'm talking with fund managers that manage tens of billions of dollars, and these are the tools they incorporate. And they come to me for help with incorporating these tools, right? So, and then they're very simple. You're going to see here, there's nothing complicated. So let's get down into the secret sauce. Let's just dive right in, right? Like why start with like a derivative? You want to know the secret sauce? This is the secret sauce. This is the top-down approach, okay? We're starting from the top. We're looking at planet Earth like if we're standing on the moon, because a lot of us here are interested in stocks, right? But we can't just look at stocks in the United States. Even if that's your end goal, we need to look at stocks as an asset class. There are countries all over the world. I've been very fortunate to have been able to speak at many of these throughout Europe, London, Dublin, Amsterdam, Greece, all throughout Asia, Singapore, Taiwan, Hong Kong multiple times, India several times. So, and then all throughout North America, of course. But what have I learned throughout those experiences? Number one, how globally connected the stock market really is. And it's an asset class. It's not a country by country, number one. Number two, I don't care. I'm Cuban from Miami, and I'm in Tokyo, our cultures, or in India, and our cultures couldn't be more different. But from an investor psychology perspective, we are all the same. It's scary. So anyway, we look at every stock market index in the world first, and then we go to our individual stock market index, right? So and when I say indexes, we are looking at the S&P 500, the NASDAQ 100, the Russell 2000 small caps, the mid caps, the New York Stock Exchange Composite, right? The Dow Jones Transportation Average. There's a slew of these indexes, just like there's a slew of countries around the world, both emerging and developed. And what are we doing when we're going through these? We're trying to figure out if they're going up or down. Are more of them going up or are more of them going down? I think most investors try to make an investment decision without first identifying the direction of the asset in question. Are people agreeing with you? Is it going up in price, or are you trying to be a hero and trying to get something on the way down? Your probabilities of success are going to be much higher, and your hit rate is going to be much better if you are trading in the direction of the underlying trend, regardless of what your time horizon is, right? Simply, that's just math, right? You're just, at the end, you're going to have more successful trades, right? That's just what it is. So we're trying to see if more of them are going up or down. All the stock markets around the world, all of the US stock markets across market caps. And then we get to the sector level. There's about 11, 12 sectors, depending on who you ask: energy, technology, communications, utilities, healthcare, financials, right? Those are all the sectors. But within each sector, you have sub-industry groups. So for example, in financials, you have regional banks, broker-dealers, right? You've got insurance stocks. Those are very different types of companies. In healthcare, you've got medical equipment, you've got pharmaceuticals, you've got biotechnology, managed health. Again, very different types of companies. So not only do we want to analyze the sector level, but the industries within it. And then ultimately, we'll look at the individual stocks that make up those components. So by the time we decide we want to buy Abbott Labs, 95% of the reason we're buying Abbott Labs has nothing to do with the chart of Abbott Labs. It probably has to do with the fact that we like stocks as an asset class. We like US stocks, probably like large cap healthcare. We probably like medical equipment. And it just so happens that Abbott Labs is the best risk versus reward opportunity to express that thesis in the market. And that's what I consider the top-down approach. How'd I do there with the first step there, Jay?
I think it's absolutely brilliant. This is oftentimes overlooked. Maybe if you're just joining us, you're like, okay, when are you going to get to the good stuff? I ask all of you who are watching this right now, how closely does this represent your approach to analyzing the markets? Are you oftentimes, and I'll admit this, JC, I'm one of these where I have sometimes jumped right into my portfolio and into a specific stock. That's where I started. When I open up my laptop or I'm going to go and look for maybe a new investment opportunity, I start with my own portfolio and I look micro. I do the opposite. I look at the bottom and then I go to the top. So if you're like me, let me know. We want an active chat here. So let us know if that's you, first and foremost. Second is I can't understate how important it is to recognize that all of the best investors, traders of all time, none of them, I can't think of a single one, was good at one thing, like just the tech sector or just this, the utilities or something like. When you speak to them, you read the books, you read their blog articles, you listen to them speak, they all start with the macro picture. They understand how they're one thing that they're emphasizing and one thing they're focusing, and how the world is flat and how so many different sectors are feeding in information and could have a small impact or a major impact. But regardless of it, they're cognizant of that. And the chats are blowing up here. I love this. So it's like, yeah, I look at my stock first. Guilty. Thank you for that, for admitting that. This is the first time someone's hearing your approach, JC.
You want to put it in play? You want to see what we were looking at coming into the year?
Yeah, let's do it.
All right, cool. All right, so let's look at that so you guys can actually see it in practice. But I want to mention one more thing. So when we talk about how we start with a global macro top-down approach, and I'm talking about the international stock market, part of the international stock market indexes work is the intermarket analysis that we're doing, where we're looking at all the international markets, but we're also looking at all the commodities futures markets, from gold and silver to natural gas and crude oil to palm oil futures in Malaysia and everything in between. We're doing the same thing with probably the top 60 currency crosses in the world, not just euro, yen, British pounds and Aussie and CAD, but Naki, Saki, and again, everything in between. We're looking at the interest rates markets across the curve to about 20 of the most important economies on earth, and then the intermarket relationships among them all, right? That's what we call cross-asset analysis. There's so much information there. We're going to get into that in a minute. So part of the top-down work is including what the direction of other asset classes. For example, emerging markets and copper move, emerging market stocks and copper move tick for tick, right? They look exactly the same. The US 10-year yield and regional banks relative trade tick for tick. So there's a lot of intermarket relationships that you can get information. And again, will increase probabilities of success. So we'll do all that. And then we'll dive into the US indexes, like I said, the sectors, the industries, and then ultimately the stocks. That's the top-down work that we do. So I've said it before, I'll say it again. The 2020 stock market crash earlier this year came after more warning signs than any crash in history, okay? For the simple fact that we have more data points now, so the math is simple. But truthfully, it was really, there were plenty of signs. So let's go over just a few. This is in January, late January 25th, we put a sell stocks, buy bonds, right? This was January 25th of this year because we had a lot of success in the fourth quarter of 2018 when bonds started. We're looking at bonds relative to stocks. So bonds is the numerator, stocks is the denominator, NASDAQ 100 in particular. So as this ratio goes up, bonds are outperforming stocks. As this ratio goes down, stocks are outperforming bonds. So in 2018, bonds absolutely ripped relative. If you guys remember that crash in 2018, it was great. We were short. It was fantastic. And then what happened to this ratio? We got right back to this level. So if you're bullish stocks, you're wondering, man, this would be a perfectly logical place for bonds to start outperforming stocks. Maybe we should reevaluate that thesis, which is part of the fact that there's no one holy grail. There's no one magic indicator. It's a weight of the evidence top-down approach, right, is what we're doing. So then I'm looking at the bond market here on January 25th, and I'm like, man, the way I learned it is the more times the level is tested, the higher the likelihood it breaks, and the US 10-year yield keeps bumping down against these levels. And if it breaks, holy cow, and where I come from, triple bottoms don't exist. So I think interest rates are going to collapse. So if I think interest rates are going to collapse, what's the obvious trade? Well, obviously buy bonds. Here we are, bonds look to be at a perfectly logical place to outperform stocks. So that makes perfect sense. And then I need to wonder, well, if interest rates are getting slammed, what's the stock market doing in that environment? Is it probably doing well, or is it probably under pressure? And if interest rates are getting slammed and money's moving into bonds, stocks are probably under pressure, was the bet that I was making, right? So meanwhile, we're comparing stocks, what the interest rate market is doing to the copper gold ratio, to the regional banks versus REITs ratio, which, as you can see, all three of these look exactly the same. They trade tick for tick. And I'm seeing stocks confirming the breakdown in rates. I'm seeing commodities confirming the breakdown in rates continue, right? So buy bonds, sell stocks. Meanwhile, the S&P 500 is hitting our Fibonacci extension level. This was our target. This is still January 25th of 2020. So as the bond market is giving us signals that we should be buying it, and the ratios are indicating bonds are going to outperform, at the exact same time, stocks are hitting our upside objectives. Here's the S&P 500, and here's the Global 100 Index, both hitting their upside objectives at the same time as we're getting these signals from the bond market and the ratio analysis. Meanwhile, Japanese yen, which is where money goes to hide, this is as risk off as it gets. When stocks are under pressure, money's going to go to Japanese yen, and I'm seeing a squeeze potential in yen. And if yen is squeezing, are stocks probably under pressure, or are stocks doing well? Stocks are probably under pressure, which makes perfect sense because the bond market's saying the same thing, and stocks are hitting our upside objective, right? Meanwhile, fast forward a week or so, or 2 weeks, I should say, and I've already put out my sell stocks, buy bonds call, and the S&P 500 went on to make new all-time highs for 2 more weeks. So the trolls on Twitter are like, haha, JC, you suck, and I'm like, okay, I didn't say anything. I don't respond to people like that, but like, I understand the psychology. What they're missing because they're too busy trolling and not analyzing stock charts is that while the S&P was making new highs, mid caps were putting in lower highs, small caps were putting in lower highs, micro caps were putting in lower highs. There was basically nothing left making new highs, just those individual indexes. So while they're saying, haha, JC, you suck, I'm like, all right, I guess we'll see. Meanwhile, the Russell 2000 is running right into that level from where we started shorting it in 2018. So the bet was short Russell 2000 if we're below 169. Meanwhile, while the trolls are like, haha, JC, you suck, S&P 500 is making new highs, the advanced decline line's putting in lower highs and putting in a bearish divergence. The Dow Jones Transportation Average is putting in a Dow theory sell signal all at the same time while the trolls are saying, haha, JC, you suck. Now, what I want to point out here is because we're going to talk about the opposite at some point, which is what's happening now. What led me to believe that industrials are making new highs and transports were going to confirm? Like the bullish argument here was that transportations were going to make new highs and confirm what the industrials were doing. My bet was that that's what was not going to happen because transportation stocks were actually breaking down relative. So the bet was industrials would catch down, not transports catching up. That's where and we'll get into relative strength in a minute. Meanwhile, regional banks are making all-time new relative lows, the lowest ever, as the S&P 500 is quote-unquote breaking out. And then finally, from a risk management standpoint, consumer staples outperform when stocks are under pressure. Consumer staples underperform when stocks are going up. So I'm seeing the S&P 500 making new highs, and I'm seeing consumer staples outperforming, suggesting that the market is already rotating defensively. All of this is happening at the exact same time before the stock market crashed. And then taking a look at the internals, with new highs in the S&P 500 in February, we had a fraction of the percentage of stocks making new 21-day highs. So fewer and fewer components participating, which was the opposite that we saw in the spring. As the S&P 500 recovered and made new highs, we saw double the amount of stocks making new highs. Breadth expansion, the opposite of what we saw back then. Same thing with the 21-day highs, a fraction, right? So these are the percentage of 21-day highs in the S&P. I guess this is the same chart, sorry. But I had the 63-day high chart, which I was going to show you guys, which is basically the exact same thing, and it really shows that. So that in a nutshell is the top-down approach. That's step one. I promise you step 2 and 3 are much quicker, much simpler, and you can overlay those two onto this one, and you got your 3 steps, baby.
Beautiful. So step 1 is to take a look and see exactly how each one of the what's happening in the international stock market indexes compared to the stock market, compared to the U.S. sectors and industries, and then the specific U.S. stocks, and then you can make money-making decisions. And it is true, everything that he's showing you, you can go to All Star Charts blog and see he posts everything. He called for the collapse before the coronavirus. He didn't say because there's a virus coming from China that's going to destroy, 2020 for everybody. He doesn't do that. He's not Nostradamus, where he's making those types of bold claims. What he simply does in a very beautiful way is sees how, like you use just your words, you're using evidence, you're finding evidence. And you do that by comparing and contrasting. A good analogy that came to my mind to compare this idea or strategy with someone is a lot of you may be coming from the traditional way of analyzing stocks, which is through the fundamental approach. Let me ask you, anybody who's got some strong background, whether you are a CPA, whether you just have a passion or a hobby at understanding how businesses operate, would you ever invest in a stock by looking at simply the EBITDA? Would you ever look at a stock just based off of their cash flow or their cash balance? One specific thing? Of course not. You would give me your approach to analyzing the health of a company and whether a company was undervalued or overvalued by looking at a multiple of different stats in order for you to draw your conclusion. And what you're looking for is evidence one way or another. It's overvalued or undervalued. This is a good opportunity or not a good opportunity. JC has done the exact same approach, but is using technical analysis as the way to implement this. And I believe it's a far more effective, quicker way and allows you to see more from a global macro than you would from a fundamental approach. But well done. Let's see what step 2 is, or if you had something specific you wanted to go over.
No, I think you said it best. I mean, it's a really a weight of the evidence, top-down approach. It makes it really, really difficult for us to miss anything because we're really doing the whole work. And like a lot of our clients, most of them are not going to rip through 5,000 charts a week and tell them what all these international markets are doing or all these sectors are doing. Like we'll do that for them, right? But that's the analysis, right? Like, in 3rd grade division, like you could probably figure it out in your head, but the teacher makes you show your work. That's us.
Yeah, I will. That is a good point that you just mentioned here. We promise you guys I won't keep interrupting JC, but this is a good point. And something we didn't cover in the intro for you. But JC literally has been hired by every single major institution and bank to share his analysis of the stock market with them. So what you just saw him do, it was so effortless. You could tell that you're an expert in this. And JC wasn't doing this yesterday. He didn't become a CMT yesterday, and he's showing off his new jargon that he just learned last week. This is somebody who is not just hired, but actually sought after. Somebody who is unbelievably well respected. He's been seen on TV a bunch of different times, and he is invited. He has been all around the world, invited to speak, to talk about this specific subject. So I love that. So, and someone just said, I can vouch for that top-down technical analysis approach. Wrote JC's bond trade. I won't read the rest of it, but he wrote that trade and made a lot of money off of it. So
yeah, Roxanne, how do you get to all these charts? You know how I get to all these charts? Because this is what I do. Like, I don't do anything else. Like, I don't do all this other analysis. I don't like have a different business. Like, this is what I do. So like, for other people who do other things, I can see how that's harder, but like, I don't, spend time with my family. I go to college football games. Like, I like nice wine and stuff like that. Like, I have a social life, but as far as work is concerned, and as when I'm off and I'm having fun, like looking through charts is fun.
Yeah. It's a great question though, Roxanne.
Yeah. All right. So let's get in. So that's the top-down approach. That's the weight of the evidence, global macro. Showed you sort of some of the different tools that we use, to analyze the direction of the markets, like breadth and things like that. So now, when people say, JC, what is your favorite technical indicator? Or what's the most important technical indicator? The answer is price. That's the most important one. Everything else, no matter what it is a far, 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 far second, right? The only thing that pays is price. That's all that matters. Everything else is supplemental to price analysis, to analyzing the direction of the underlying trend. That is numero uno. Everything else is far second. So I want to reiterate that, number one. Number two, I talk to traders, hedge funds all over the world. They're looking for two things: momentum and relative strength. Why? Because if these traders are trading stocks that aren't moving, they're going to get a tap on the shoulder and they're going to get pulled into the principal's office and they're like, why are we paying you all this money for you to trade stocks that aren't moving? And then if they're buying stocks that are underperforming their competitors or their peers, they're going to get a tap on the shoulder and say, hey, why are we paying you all this money to right? So they're looking for stocks that are outperforming, stocks that are moving in a direction, right? They're looking for momentum. They're looking for relative strength. So those are the next two tools. So what does that mean? You hear those words all the time, but what does it actually mean? Well, there's a lot of momentum indicators, MACD, ROC. You could build your own using code, all sorts of stuff. I use a 14-period RSI. It is a relative strength index, not to be confused with relative strength, which is two assets compared to one another. This is a momentum indicator. And when I say 14-period, if I'm looking at a daily chart, it's a 14-day RSI. If I'm looking at a weekly chart, it's a 14-week RSI. And it's an oscillator, which all it means is that it goes from 0 to 100, right? So it's RSI is a momentum oscillator. There are two ways to use it. Number one, if identify the regime that it's in. Is it a bullish regime or bearish regime? So in the same way that we identify the direction of price, is it making higher lows and higher highs, or is it making lower lows and lower highs, right? The same way we do that, we do the same thing for momentum. So 70's overbought, 30's oversold. When stocks are in uptrends making new highs, you're going to get overbought readings. That is perfectly normal. In fact, that is a characteristic of an uptrending market. When people are like, oh, JC, I can't buy this stock because it's overbought, how can an overwhelming amount of buying pressure possibly be a bad thing? It's not, right? So when we're seeing overbought conditions, that's characteristic of a bull market. However, nothing goes straight up. So when you see corrections, if you see oversold conditions in something you think is an uptrend, you probably want to reevaluate that thesis. Same thing in a downtrend, right? When stocks are making new lows in a downtrend, you're going to get oversold conditions, right? That's characteristic of a downtrend. However, when you get those counter trend rallies, you're not going to get overbought. You're not going to get above 70. If you do, you probably want to reevaluate that bearish thesis. So let's take a look at some examples. Here's gold futures. This is back in 2009, 2010, 2011. Just higher highs, higher lows, above an upward sloping 200-day moving average. Notice how when it made highs, it kept getting overbought, right? Kept getting above 70. But when it got oversold, when the stock sold off, or in this case, gold sold off, we never hit oversold conditions, right? Because we're in a strong uptrend. Classic. So speaking of classic examples, how do we talk about downtrends without financials in 2008, right? Seems like the logical choice. And here's JP Morgan, just the bellwether of financials. Making lower lows, lower highs, below a downward sloping 200-day moving average. Notice how when it would make lows, we're getting oversold. Notice how when we are getting these counter trend rallies, which in some cases were incredibly vicious, I know for a fact because I was short in some of those. It's not a pleasant feeling. And you notice how we never got overbought conditions. So they ultimately rolled over again, right? Classic for a downtrend. Then the second way we use momentum is think of a tennis ball going up in the air. You can see the momentum slowing down before the tennis ball hits its peak and starts to fall. Same thing in stocks. So here we're looking at gold miners at the beginning of 2016. I remember like it was yesterday. We were so bullish and we were so underinvested in hindsight, but bullish nonetheless. And we broke down and made new lows in gold miners into early 2016. I remember this was like right around New Year's. It's whipsaw hunting season, as we call it. And this is probably a big reason why. So notice how on lower lows in gold miners, momentum put in a higher low. That's what we call a bullish momentum divergence. And that tends to happen at turning points when markets are changing direction. Fast forward, look at that monster move with higher highs into that summer. We had lower highs and momentum putting in a bearish divergence before gold miners ultimately rolled over, right? And by the way, it took them 4 years to break out again. And that just happened recently looking back. So the third tool, so very simple, momentum. And the third tool is relative strength. So in relative strength is when we're comparing one asset to another, maybe two stocks to each other, maybe one stock relative to the index, maybe a stock relative to the sector it belongs to, like JP Morgan relative to the financials index, or ExxonMobil relative to energy, or we can compare healthcare to the S&P 500 or the S&P 500 to emerging markets, right? All of these are ratios to understand where the relative strength is. So here we're looking at small caps versus large caps. So small caps are the numerator, large caps are the denominator. As this chart goes down, that's small caps underperforming. As this chart goes up, that's small caps outperforming. Here we're looking at Amazon relative to the S&P 500. So as you can see, outperformance throughout 2016 and 2017. So there's wisdom in relative strength, right? That's evidence of institutional accumulation. While the S&P 500 was rolling over in 2015 and didn't bottom until early 2016, Amazon had been outperforming that entire time. And what's it done since then? It's been a monster. Look at banks. Look at the S&P 500 making new highs into October of 2007. Look at the regional bank index. It peaked earlier that year and on a relative basis had already been putting in new lows. This was eerily similar to what we saw this March. So when I tell you that there were more warning signs before this crash than any crash in history, I just showed you a bunch of examples of other times too. They look exactly the same. So shouldn't have been a surprise to anyone, as far as I'm concerned. I don't know if you wanted to put this.
Yeah. So that's that was a really, really great point that you just made there about how clear it was. And so I'm interested to hear how many people saw it coming, truthfully saw it coming. I did not see the crash coming on my own. Obviously, I read what JC wrote and was able to be positioned for it. But personally, it wasn't something that I caught. Did anybody, are you with me? Can you admit it? Yes, great. If not, and you did see it, let us know. That's great. I'm not going to call you out and be like, how did you know? I just want to know how many people see the rig. Thank you so much. We've got to know. So there are absolutely people who, and some people are new to it. That's fine. And so there are some rumors, right, that it was overbought. There's some of the comments that are coming in. I appreciate this. Again, this helps us when I hear this type of feedback. Second question I have for everybody, and you can keep letting us know. Someone else is new. I don't understand much. Let us know if you saw it or didn't see it. So as this is coming in, second question I have for you is, when you are looking at your portfolio and you're analyzing positions, how many of you are seeing that what you concluded with your analysis tended to be correct? Or when you are doing your analysis and you're left with, I still don't know. You spent time, you did research, and you still don't know. Be honest with me. For those of you who don't know, I'm the founder of TradeStocks.com. I worked for a hedge fund for 7 years. I was a financial advisor for 3 years. I know a lot about how the markets work. I've helped several hundreds of investors manage 2008. I started in 2004. I worked at the hedge fund, traded futures contracts, options on futures contracts. I've done it all, right, in our space, so to speak. And I will be the first to admit that I will look at and analyze the markets. And when I'm done, I am no more convinced when I started the process to where I was when I ended the process. And that is because I don't have a systematic approach like JC has developed over 20 years of experience to go and analyze something systematically. It is the same every single time. So what seems effortless, and you're going fast, JC, explaining some of this stuff.
Sorry about that.
No, it's because it's like asking Michael Phelps, so how do you do the backstroke? Well, you just do this, and he just swims 15 laps by the time you get done asking your question. He doesn't know how to be like, well, because he's been swimming, forever. So that is exactly the same when it comes to you. I'm just trying to fill in and color in the blanks and ask you guys to challenge yourself as well. So some people's like, yeah, like an infant, I'm still trying to figure out where to put my focus. Trading, management, money is always way harder than ever imagined. Wasn't aware of until JC's viewpoint. You guys, these honest feedback questions are awesome, and I love it. So thank you for the honesty. And managing your own money is way harder than I ever imagined as well. I manage other people's money. And because JC said it in the beginning here, that we as humans are not built to be investors. Okay, we're not. We are risk adverse. We are filled with fear. We're constantly trying to use our five senses to understand what's going around us. And it is impossible to use your five senses to analyze what's happening between the bond market and the 400 stocks that are there. You can't do it. You can't. You have to teach yourself how to do that. And that's what is the difference, I think, between a lot of people. But JC, I think you were gonna show us something there. I didn't mean to go on such a tangent.
Oh no, I like your tangents. You always say such nice things about me. I wish my wife said nice things about me like that. I wanted to just reiterate something that we do all this top-down work. But for our clients, what we're doing is that we're supplementing all that top-down work with a series of universes that are bottoms up. So because there's like, for example, the 2 to 100 club that are stocks that are graduating from 2 billion north. So now they're becoming mid caps. They're no longer small caps. They're getting on our radar. We've got the under the hood, right? That are just stocks that are seeing an unusual increase in investor interest. So those are bottoms up universes that we just get a list of stocks and then we do our analysis on top of that to supplement all the top-down work. Itai was just putting in the chat, this is his favorite, the young aristocrats, right? And now, Jeremy, I'm seeing a few gray hairs up there. The young aristocrats list might be attractive to you, no?
Absolutely. Absolutely. I also enjoy this very much.
But let me do a little myth busting. While the old timers really love their high dividend paying stocks, and young financial advisors that see their older clients and see how much money they've made from dividends over the years. Like, people who have that real experience with seeing how those dividends add up over time know that. But even if you're not in that case and you don't really care about the dividends, at the end of the day, this is a list of stocks making new highs. This is a list of stocks in uptrends. So whether you're interested in the dividends or not, it's still a sexy list, which is what I like, right? So what we're doing is, I don't know if you guys are aware what an aristocrat is. So an aristocrat is a stock that has raised their dividends every single year consecutively for at least 25 years. That's an aristocrat. So like Coca-Cola, Johnson & Johnson, for example, they've raised for over like 60 years or something like that, or almost 60 years, to put things in perspective. So what we're looking for is those future aristocrats. So we're looking for what are referred to as contenders. So these are stocks that have raised their dividends every year for between 5 and 9 years. So they're not yet aristocrats, but these are going to be the future aristocrats. The future aristocrats have to come from this list. So they're growing their dividends every year. And then simply as a function of our filters, they have to be making new highs, right? Because the only way for them to continue to raise their dividends is for the stock to be making new highs, which decreases their dividend yields, right? So we're not looking for super high yielding stocks that are paying a high yield because the stock's gotten crushed. That's not what we're looking for. We're looking for stocks making new highs, consistently raising their dividends. That's the goal. And then what does that do? Well, that just creates, now we just have a list of stocks. That's all it is, right? So it's not like, well, in this case, a list of stocks going up. In the case of under the hood, it's just a list of stocks getting a lot of attention, and that could go either way, as you're well aware. But in this particular case, there's stocks that are going up, that people are buying, that are paying high dividends. And I wanna show you one particular idea. If you don't mind, can I share an idea?
Yeah, please.
Let me share an idea. You'll notice here, if you look closely, there's a one Domino's pizza, right? Which is forbidden to be eaten if you're a bougie pizza guy like myself. I actually got it yesterday, but that's a whole nother story. I was doing my fundamental analysis because I need to see what the hell's going on and why the stock keeps making new highs.
So you had to order the pizza yourself and try it. It makes total sense to me.
That was my fundamental analysis. That's the extent of it. I'm like, I could get used to this. I wish the pizza was better, but I could do some eating. You know what I mean? So this is where we're looking at Domino's Pizza. For a variety of reasons, this 369 level is a very, very important level. And we only want to be long if it's above that. So if Domino's Pizza is not above that level, we do not want to be long. But they continue to raise their dividends. If I see here correctly, Domino's Pizza, eight consecutive yield, eight consecutive years. It's paying only less than 1% because the stock keeps going up so much that the yield keeps going down. But you can't hold it against it. And the payout ratio, which my fundamental analyst friends tell me is important, is only 27%. So they're only paying a small fraction of the money that's coming in, which, like I said, my fundamental analysts say that that's a very good thing. I'll take their word for it. I prefer the risk reward. I don't give a damn about their payout ratio. I want the risk reward. And if it's above 369, I think we can own it. I think this thing can go to 600 and then hold on. Wait, there's more. I have an options trade. Can I share the options trade?
Please. Now, this is stuff that you guys, you didn't come here tonight to see this. So this is all a bonus and on the fly. I haven't even seen this. So yes.
All right.
Please.
So we're doing the March DPZ bull call spread. Implied volatility is a little pricey, and we all don't have Jeremy's wallet. So, we need to sell an out of the money call option. We're going to be selling the 450 calls, taking that income, and then using that money to pay for our 400 calls, right? So it's a bull call spread, and we're able to get it for $16, the $16 debit that we want to sell for $33. As soon as the debit hits $33, we are going to be taking our profits. That is 50% of our maximum potential gain. And that's where we want to be taking our profits. And if you're not interested in the options and you're a stock junkie.
What month is that?
March 400, 450 bull call spread.
Awesome. March 400, 450 out of the money bull call spread. Define risk. A bull call spread means that you have a maximum risk potential. In this case, 16. And then you have a max profit potential. And it's important to note that JC is mentioning that we are not trying to capture the max profit potential, but a set profit potential. So he's giving you the dollar amount of the worth of the option. So 16, get out at 33. This is March 2021 on Domino's Pizza. And yes, completely new to me. I love the look of this chart. Obviously, my brain, and I bet everybody else did here too, when I think of why Domino's Pizza could be making more sales, it's because everybody's going to be staying at home, right? No one's going up. It's not the taste of the pizza, but the convenience factor of the pizza. So that's what it is. Someone else said, I liked Domino's above 400. So to get over 400 personally. So everyone can have their own opinion about what they like and don't like. That's the beautiful thing. And it is worth mentioning that, because I didn't know you were getting into this, this is just for educational purposes only. Trading involves risk of loss, isn't suitable for everybody. So please, trade at your own risk and look at your own account and make these decisions. This is for educational purposes only. What I'm excited that you just did here, though, is that you got really down to the money. So in the very beginning tonight, and I just want to kind of encompass everything that we talked about, but in the very beginning, that very first slide that you showed was a top-down approach with the bottom one being the money. And right here is a perfect example of how the heck did he find Domino's Pizza to come down here, all the way here to a money-making opportunity. And it started there. Thank you so much, JC. It started right here. Believe it or not, his road to finding opportunities like Domino's Pizza starts with this international stock market index, US stock market index, looking at the sectors and industries, then into US stocks, and then the money where you see the dollar signs here is the Domino's Pizza. When you just pull and show and just talks about Domino's Pizza, or they talk about Zoom, or they give you anything. A lot of these analysts that are out there, talking heads that are out there, and they pull out one of these things. It's important to ask yourself, how did they get to this? And yes, there are people just like you who just pulled it out of thin air. I know that you guys do that. I do that too. Okay. You just randomly think of a company like, oh, I'm going to check them out. You hear the news talking about them. You see a CNBC article about them or a Market Watch article about them. And then you make your analysis from there and you go real specific with that company. If you're looking for consistency, asymmetric risk to reward ratio trades, you need to have a proven methodology. So step one was to do this top-down approach. JC, you look over 5,000 charts every single week. Someone asked, how do you do that? It's because it's JC's full-time job. If you're here tonight, it's probably because you are good at something. You're not watching how to, maximize your return on an investment if you don't have any money. So if you have money, it's most likely that you're good at something. And you got good at something because you spent a lot of time and effort. You were gifted in some way. In my opinion, we're talking and listening to the most gifted chartered market technician on the planet. That's my opinion. I think that's JC. His results speak for themselves. And then go to the next slide where you went into your next 2 and 3 steps, where you looked at their RSI and then you looked at relative strength, right? And so he looked at, yes, these are the next, and the momentum basically of the particular stocks. So then he goes into and looks at these and went through all these different examples of how he was able to show this. From there, that's just fine. It's taking this macro view. He's standing on top of the moon. Now he's in the atmosphere. Then he comes down, puts his boots on the ground into a particular country, walks over to a city, and then opens up the door to a business. That would be like that approach coming all the way down. And for many of you who are here tonight, you're asking yourselves, well, I don't know how to do this. It's true you don't. I'm not consistent. You're not. You are making mistakes. Yes, you are. And you need help. And so the purpose of all this is for us to go and show you his top-down approach, his 1, 2, 3 step that everybody can do to go and help be more of a consistent, profitable trader. And if you want to go to the very last slide, thank you. You just beat me to the punch. This is what we're talking about, is the ability to join in on the mind share that is JC Peretz. His 20 years of experience, you are going to be able to join and get access to that tonight. So this is an open invitation for any of you who are brand new to trading, who are just now starting to become an active investor, who want to take advantage of what has been an absolutely phenomenal year. Okay, there are more traders trading this year than ever before. And if you want to get in on this, this is the way to do it. And you're going to get access to everything that you see here. But JC, why don't you tell them about your service? This is your baby. This is how you make a living. And this was what makes you a professional. Tell them what you're going to give them.
Yeah. I mean, it's really just an ongoing conversation with me about what I'm talking about, the ideas that I'm getting. We're doing the top-down approach that we discussed. We have these bottoms-up universes that we discussed. And then it's really the conversations with friends and colleagues and clients that really add that little sprinkle of magic to it that, it just really truly is a blessing, because I get to learn every single day from really smart folks. And, I'm willing to admit they're way smarter than me. I'm okay admitting that. So let's see what we're going to do. So the trade ideas. So a lot of people, we do all this global macro work. And Jeremy, the truth is some people are just not interested in. They're like, JC, I don't really care about your Lithuania chart, bro. Like, just what's the trade, And that's cool. Like, no offense. We can still be friends. It's all good. I'm still going to do that work and I'm still going to present it to you. But if you just want to get down to the nitty gritty, JC, what's the damn trade? The trade ideas page just outlines everything. You can click on the trade idea and it'll take you to all that homework, and you could go down that rabbit hole that we went down if you really like. Some of you really enjoy that. I certainly do. So that's all good. And if you don't, you just want to trade, okay, buy it if we're above 70, sell it at 100, done, right? Great, that's cool too. So that's the trade ideas page. Then what I'm really excited about is our chart book. So we've had a chart book in the past, and we've had a bunch of JC's charts. I hate to talk in third person, but that's what it says, JC's charts. So, there's a bunch of my charts, and, the breadth stuff that we do as a team is also on there. But the chart book that we're about to drop is going to be primo. It's going to be so sweet because we have all these new charts and all this new software. Like, there's all this fancy stuff that's way above my pay grade. But very excited about the new chart book. Then the monthly conference call, which, when I talk to our clients, they say the monthly conference calls are their favorite part of the whole thing, because we just go over all those charts that we looked at from January and February, all those were from the monthly conference call. I just copied and pasted them, dragged them in so we can kind of show that thought process. And what do you think, Jeremy? You like those monthly calls?
I was just going to say, that's actually one of my favorite things as well. If you look at it, again, it's all about an approach. And for me, it's easy when I can see how something works and how all the pieces fit together. And the way that you do it, JC, is so cool. So, and in my mind, every single month is like a break in like a basketball game, how they have quarters, and like you get to take a break and come together as a team, talk about how the last quarter went, talk about what your plan is for the next quarter. Are you down? Are you up? What are you doing? So these monthly calls, he's basically taken a year and broken them into quarters or into these monthly calls. And it's a time to regroup and reset. And we're looking at data. When you're looking at a day's worth of data, that's a little bit of information. You're looking at a week, it's a little bit more. If you're looking at a month, that's a lot. It's a lot of information. It's enough information to be statistically relevant to make clear-cut plans for the next month. And so, yes, I absolutely love them. The analysis that's gained from them, the insights and the education. And you always over-deliver. These monthly calls are some of the most impactful ones. And not to mention, they're the same monthly calls that institutions and hedge funds and some of the biggest players in this space are looking for you to give them their information on. I mean, this is how he pulls out all the information for them as well. So the fact that I get to have access to the same information that some of these big banks and institutions get access to is just cherry. It's just a cherry on top.
Funny you said over deliver, because here it just says monthly conference call. We're actually doing 2 monthly conference calls now, because we do the monthly conference call, which is next week coming up, by the way. But we also do one at the beginning of each month where we specifically look at monthly candlesticks and look at the long-term part of that top-down approach that we do at the beginning of every month. So now there's a second one. So your over delivery was was funny. It was apropos. So premium members get access to all of our research. So we were looking at biotechs over the last couple of weeks, and so we did a deep dive on biotech stocks. So you get access to that as a premium member. We're putting out a marijuana stocks report that's about to drop in the next day or so because they're moving, right? So depending on what the market's doing, we're doing some stuff on the genomic stocks that's about to drop as well, the Human Genome Project and all that stuff. Again, speaking of above my pay grade, I'm more interested in the fact that the stocks are working, but needless to say, they're working as a group. So we're doing some further deep dive in that. So that's what you have access to, a 24/7, of course. And then, as I sort of alluded to before, we do all this global macro top-down work, right? All the stock markets in the world, all sorts of corn futures and soybean futures and more futures contracts that you know what to do with, ultimately to come down to let's buy dominoes. But we're having a series of universes to supplement that work from the bottoms up. We have one scan called the 2 to 100 Club, which are the stocks that we think are going to be the next $100 billion companies. In fact, just mathematically, the next $100 billion companies have to come from this list, right? Because the way that this list is built. So they have to be one of 13 industry groups that we think can scale from 2 billion to 100 billion. Solar, semiconductors, cloud computing, right? The obvious, right? Software, right? Cybersecurity, right? The obvious ones that can actually scale, not an industrial company, right? So those are the names. So a lot of technology and things like that, a lot of discretionary direct to consumer that we think are going to be the next $100 billion companies. Zoom was on there. Peloton was on there. Snapchat, like monster winners for sure have come from there. That's Straz's favorite, one of our analysts. That's his favorite scanner. I know you're not supposed to say like, who's your favorite child? Like who's your favorite kid? Like what's your favorite bottoms up universe? But 2 to 100 is a good one. I really like the under the hood. Because like you know why I really like Under the Hood? Because it's long and short. So 2 to 100 simply as a function of what it is a long only scan. But the 2 to 100 is just giving us, the Under the Hood is giving us the stocks that are showing an unusual increase in investor interest. So like Nikola, it was a short. You know, ExxonMobil was a short. You know, these are shorts that are working in bull markets. So like, that's how you know the scan works, when the shorts, you know, right? So the Under the Hood, longs and shorts, right? All it tells us is that a bunch of lunatics are paying more attention to this stock all of a sudden. And we get and then we go to work, right? And then we use those tools that we showed you about. And then of course the Young Aristocrats, which we just showed off here earlier, that are stocks that are continuing to increase their dividends, making new highs. You know, great list as well. And that's how we generate our ideas. That's how we put the pieces of the puzzle together. And we're continuing to make it better. Like if we had another hour, I could tell you on all the cool stuff we're working on. Like, Jay, you don't even know, dude. You don't even know.
Yeah. So this is a good point. I should have said this in the very beginning, but those of you who are here and you're taking a look at this offer, this is the whole enchilada. So when we started this, the charting room, the 2 to 100 wasn't there. The Under the Hood scanner wasn't there. The Aristocrats wasn't here. So as he continues to build and grow, and he does have some absolutely phenomenal ideas, your membership is going to grow in value as well. And so that's the cool thing about what JC and All Star Charts and their whole team is all about. And so what you're getting access to is their premium membership, which is everything that they have been working on and putting together. And each one of them in their own right is extremely valuable. The 2 to 100 club, just think about that from a portfolio perspective. You're investing in a company that went from $2 billion to $100 billion. If you in Apple, when it was $100 billion, it went to $1 trillion, you're probably not on this call. You know what I mean? You've made a lot of money. And so that is such an interesting approach. And how are you going to be able to do that? Again, it comes from analysis, and we don't need to ride out the full 2 to 100 billion. What we're looking towards is riding any movement. We need
big
movement.
Chunks along the way. Along the way.
Yeah, big chunks along the way. And so just imagine that. Imagine you being able to take advantage of that. So are you looking for someone to trust? Are you looking for someone to give you guidance? Are you looking for someone with a proven strategy that's not hocus pocus, that doesn't pull on your fear and greed strings, doesn't go and say, I promise I'm going to make you a bunch of money and you're an idiot if you don't do this. If you're looking for someone who uses a very analytical approach to finding opportunities, and not just any type of opportunities, but asymmetric risk reward opportunities, mixed with a bunch of really fun things like, these charting room webinars, these monthly calls that he does. He's got an amazing podcast, and his team is just phenomenal. You start to listen to these guys and see their emails that come out. And, we've got people here, I know, because they've been messaging us in the panels, who are really, long time followers of you, JC, who absolutely just sing your praises.
Too. We just hired Rashmi Chandri in Mumbai. She is awesome. Like this is like we just got like a serious acquisition. Like she hasn't even signed the contract yet, so I shouldn't probably even be saying this. But she's great.
That's awesome.
Rashmi Chandri in Mumbai. She is a big get. For a playoff team to like get to the next level, like this is a big get.
There are companies that, and I think everybody here can relate. There are people and businesses and companies that you can say, oh, I was there when they were at the very beginning. I ate at that restaurant before they became super famous, or whatever. Oh, I was onto that brand, from the very beginning. I feel like that's been the journey with me and you. And it's amazing to see how much you're blowing up, how famous you are actually becoming. And so if this is your first time coming here, you've come at the perfect time. You really are at the ground floor of a massive movement, and the tides have changed. We've talked about this in several of our other charting rooms, that a revolution has occurred. Some of you may be a little bit aware of it. Some of you may be extremely aware of this. But the truth is that, when I was working for the hedge fund, for example, We had to spend thousands and thousands of dollars every single month to get access to the information that we can get now pretty much anywhere. I can get on Yahoo Finance. And the information that we can all just effortlessly get on this phone, right, every single day is crazy. And so it is bringing more people to the marketplace. And that in and of itself is the revolution, because now if you can access all of these types of information and you have the right system to process and understand that information, oh my gosh. Because what did Google do? All Google did is they took billions of bits of information and gave you a logical way to go and find something. That's it. It's unbelievably helpful. We know now none of us can live without it. So there is billions and billions of pieces of information. That's the revolution. And JC is at the very forefront. He's the trailblazer. He's the pioneer that's giving everybody the way to sort, find, and use this information to your advantage for your portfolio. And that's what this is all about. And that's what you'll get when you're joining All Star Charts, is you're going to get access to somebody who is taking all of this information, this complicated information that's changing all the time, and giving you a great playbook that you can choose to do whatever you want with it. You could look at it and say, that's good to know. You can use it to make investment decisions. You can use it to get in and out of trades. But that's what this is all about. So do you need a way to systematically process all of this great information that's here to take advantage of what could be, ladies and gentlemen, we are living in some strange times. This election was strange. The 2020 is strange. And these strange times scream for opportunity. Over and over and over again, this is the time where everybody should be taking a very, very close look at their portfolio and their investments. And if you don't know what you're doing or you need help, then you can do this. And the amount of money that you'll save, just save by listening to JC, will more than cover this membership. But perhaps you may even, there's no guarantees, but maybe even make enough back and then some to cover this. I think it's a very easy feat, in my opinion.
We get that email all the time. It's like, JC, this one trade paid for the membership for the next 5 years. Or like, JC, the Peloton trade I bought with the profits, I bought my wife a Peloton, and he takes a picture of it and puts it on Twitter.
Yeah, this is really cool because I think I'll read something to you, and I won't read who it's from, but it was shared by your team, and it says that JC and Squad, I'm not sure I can properly express my gratitude and appreciation for your expertise and insight, but I'll give it a shot. Your methodology has completely transformed how I approach investing. My biggest regret is that I didn't find you earlier. I became a premium member in early 2019. Your work is truly invaluable to my process, and I've benefited tremendously as a result. So I'm paraphrasing a pretty long email, but like that's the kind of stuff that why Trade Stocks is partnering with you. That's why I'm doing this webinar, is because I get to see firsthand people giving this type of feedback to working with you, JC. And I know that's why you do this, and I know that's why you care and why you're so excited and you come up and you work so hard. It's late, and you're here championing the thing that you're so passionate about. It's because
Jeremy, I was giving a presentation in India at 4:30 a.m. this morning. I was giving a presentation.
Wow.
This is what I do. I talk about charts with smart people.
Yeah, it's amazing. So with that being said, JC, I know that you're always really good at this. Any other parting words or comments for everyone?
I always think that I take a lot for granted, because I've learned the hard way to put on some music, pour yourself a glass of wine, or a cup of Joe in the morning, right? I'm not drinking wine at 7 o'clock in the morning, or 4:30 this morning for that matter. I'm drinking coffee, right? But whatever your choice, put on some music. Music is so good for the soul. It's so good for the mind. Like, free them, like turn that TV off, like cancel the cable subscription. Like, you don't need that. If Twitter is aggravating you, you're doing it wrong. You're curating the wrong people. You're following the wrong people if Twitter's bothering you, or social media in general, Facebook, whatever you're into. This, not just Twitter, right? Like, you're doing it wrong. You live one life, and your portfolio is the most selfish endeavor that you will go on. Like, nothing that you do in your life is as selfish as your portfolio decision making. Like, when you make portfolio decisions, there's no other reason at all other than to make money or to keep money in the case of risk management, why you would make that decision. It's a very selfish endeavor. So be selfish and put on music you like. If it's jazz, if it's rock and roll, heavy metal, I don't care what it is. It's better than the noise that's coming from, you know, the people whose job it is to distract you, because the better they are at distracting you to make you think that you are in the know. You know, I used to think that I was in the know. I used to watch TV all day. I had it on all day. The first thing I'd do before getting out of bed, because I lived in Manhattan where my bed and my TV were connected because the rooms were so small, because that's New York City living in your 20s. And I would basically lean forward out of my bed and turn the TV on. You know what I mean? And I remember doing that every morning before even going to the bathroom. Before I did anything else, I'd turn the TV on, see what the futures were doing, see what the market was doing, because I thought I needed to know. And then I started doing a lot of TV, and I realized that, whoa, this is not only, I didn't actually start knowing what was going on until I stopped that. And I started putting on the music, pouring the wine, pouring the coffee, whatever, putting on some good tunes, and just seeing what's actually taking place, not a distraction machine trying to get me distracted, not informing me on what I need to know. Like, that's just not what it is. So be selfish is my advice.
Great advice, because it's so true when it comes to making money with your money, using your money as a tool. I know I think that so many people struggle with money as a topic in general because of their association with it or past experiences and things like that. But truth be told, is money is simply a tool. And if, because it's a tool, there's a certain way to treat it. And there is a way that you can treat money that's good and a way that you can treat money that's bad. So I urge you all, it's really great advice. Be selfish when it comes to using money as a tool, because that's what the tool is there for. It's to help protect you, give you freedom, let you, enhance your quality of life, to give to other people, so you can do a bunch with that tool. But if you go with it with the wrong approach or let other distractions, God knows we don't need any more distractions, man. I mean, that's right there.
If your goal is to help other people, which it is for a lot of our clients, and it is for me for that matter, like, I'm good. Like, I don't need anything. Like, I got my family. I got what do I need? I need like good charting software, like some good wine and a college football game. Call it a day. Like, I'm easy, right? So like, what I really want to do is be able to help other people. And I can't do that if I'm broke. I just can't do that. I can't do that if I lose 100% of my portfolio on a stupid trade. Like, I won't be able to help other people. So like my friend Phil, I call him, he's my rabbi, when I go to him, and he's like, somebody to talk to. And, he's like, the order is your health, your family, and your business, right? So you can't help your family and your business or whatever else is fourth and fifth and sixth on your list if you don't take care of your health, right? And this is the health of the health of your portfolio. In his case, he's talking about your personal health, but the health of your portfolio, I mean, we should treat it just as selfishly, I think.
I was just on a trip with my family, and we went to North Carolina. We went to Asheville, North Carolina for our wedding. And on the plane, anytime I've traveled with my kids are lucky. They've been on a lot of different planes. And when they go to do the safety meeting, right, and they tell you, I say, you're about to learn the most important lesson in life. And they always laugh at me. And they're like, what do you mean? What do you mean? And I wait for the moment. And it's during the moment in the safety briefing when the masks drop down and they say, put on your mask first, because you can't help anybody if you're dead.
Right. You
can't help anybody if you're unhealthy. You can't help anybody if you've got a broken leg. You got to take care of yourselves first. So I love people. I love to give. I'd love to help. So do you, JC. That's what we're about. At the same time, there are times in our lives where we need to help ourselves. And so there is one, Itai is reminding us that someone did ask if we do have just 1 minute to go and look at Amazon, just to show. I don't know if you've got time. If not, JC is totally fine. But Itai did mention it, so I wanted to see if we have time to show it. And then, yes, absolutely, health is wealth. Yes, that's another great way of saying it. I love how everybody's still. We're going to look at just this one stock, just because someone mentioned. I apologize. I know we don't have enough time. We're already over. So let's take a look at Amazon. Go ahead, JC. This is more bonus material for you. This is for you guys sticking around so late with us. Thank you so much.
what it looks like to me. And it's not a downtrend, Jay. You know what I'm saying? It's not a downtrend. Looks to me like an uptrend. Yep. An upside objective around 2,500. Right?
Yep.
You got your high. Got your high again. You got your low. You got your nice base, right? You got your breakout. You got your false start right here. Market wasn't quite ready to get down yet, right? I got the most recent data, right? Wasn't ready to get down. We break out. And here's your resistance, right? So we're looking at a healthy consolidation. In my opinion, consolidations, in my experience, tend to resolve in the direction of the underlying trend, which, unless you've been living in a rock over the last decade, it is an uptrend in Amazon. So the bet that we want to make is that this consolidation will resolve in the direction of the underlying trend. We discussed momentum, right? So this is, talk about coming full circle, right? We talked about momentum. Notice how momentum never reached oversold conditions, right? Which is characteristic of what? An uptrend or a downtrend?
Uptrend.
And like our intern busts our balls. Our intern's like, oh, you know, because we're like, oh, we don't need moving averages. And our intern's like, we don't need RSI either. And like, he's really like, this kid's like 19 years old. He's in the middle of finals right now. He lives in Auckland. He goes to the University of Auckland in New Zealand.
Oh, wow.
He's like busts our balls because we like think we're too cool for school for moving averages. And he's too cool for school for momentum. He's like, you can just figure it out the math in your head by looking at price. And while he's right, like we still use RSI, but the little, I want to punch him in the face, but he has a good point, busting our balls. He's twice his age. I think we break out higher. 3250 is probably that level. I would even, you can even own it now. I think if you're looking for an end of year rally. 3,000 has been our level, right? So it's right there, held 3,000. Call it, if you really want to be safe, call it 29.5, 2950, 3,000, that level. If we're above that, I think you could be long. I think 4,400 is next, 5,000. Why not?
Yeah. I like that call. You heard it for yourself. That's an extra bonus little tip for you. Thanks for the question, you guys. And I love seeing, what you do best live on the fly. So thank you for that analysis. And I hope you guys see, he can do this over and over and over again. And it takes me and a lot of his other members to see him do this. And you start to pick up on these little things. He's the pro. And so you can, if you're just interested and want to learn, the premium membership is going to be good for you. If you are just wanting the results of all the hard work that he's put into his craft, then, you can get that too. So, and this company and JC as a person is just getting started, you guys, just getting started. So participate, reward yourself. Buy this for yourself, for your Christmas present for you, and make 2021 your best year ever. And this would be a great way.
Community, like we have fun, like all-star charts, like hello, like are you kidding me? Like we have so much fun. Yeah. And we got some big plans. So, well, JC, great words of wisdom. Thank you so much. Health is wealth, and be selfish and listen to music. And and if you didn't hear any of that, click on the link that I dropped here, become a member of All-Star Charts Premium membership, and join the revolution with all of us crazy knuckleheads and learn the right way to analyze these markets for the first time. You won't regret it. JC, you're a gentleman and a scholar, my friend. Say hello to your lovely wife and your beautiful girl. I follow her on Instagram, and she is so adorable. Dude, her hair is crazy. I can't believe how long it is. My wife is like, how does this baby have so much hair? So freaking cool, dude. She's adorable. So congrats, man. And great seeing you, dude. All right, brother. All right. Be well.